Hey, I'm back with Craig HEMKE, one of my favorite guests, a very sharp guy. I love his commentary. I listen to interviews that he does on many other channels. tfmetals.com is the website. And, Craig, first of all, how are you, sir?
Leroy, I'm fine, thank you. It is an exciting time of year as we begin to wrap things up, and it's the holiday season and all that kind of stuff. So it's always good to talk with you, my friend.
Hey, I want to ask you, back in January, you were one of the only people that talked about end of QT and talked about
Yeah.
the fact that the Fed will fold and that we'll have a great year for the metals. That prediction has come true. I want to ask you about 2020. What can you tell us a little bit about where you think the gold market and the silver market is going in 2020?
Well, yeah, thank you. It was it was kind of outrageous, certainly contrarian back at the end of last year and early this year to predict that we'd have the best annualized gains for the precious metals in 2019 that we've had since 2010. And I made that forecast because I thought that 2019 would play out a lot like 2010. And again, seemed outrageous at the time because, you remember, gold broke below 1350 in April of 2013, and pretty much it stayed there for 5.5 years. So to, kind of stick your neck out and say that, this was going to be the year was kind of a bold statement, I suppose, but I felt very confident about it. And as things have gone, it has certainly played out that way. If you go back just a year ago, okay, we go back November, December of 2018, every 8-figure Wall Street economist, Jan Hatzius at Goldman Sachs, people like him were talking about 3 or 4 more rate hikes in 2019. Hatzius was saying 3.25% for the Fed funds rate by this time. Right. Okay. Look, we could see that wasn't going to happen. There was too much uncertainty, economic uncertainty, not in the U.S., but globally, and that the Fed just simply can't afford higher rates, not only for the economy, but the service of the existing debt, all that rates and quantitative easing. That's exactly what has happened. The Fed has now cut 3 times. The reversed quantitative tightening, bringing it to a halt. And now they're adding, the balance sheet has grown by $220 billion or whatever it is. They're openly monetizing the debt at $60 billion a month of T-bills now, at least through June. And that's only going to get worse, if you want to look at it that way, in 2020. So we're in this spot here at the end of the year where we've hit our targets. We'd said 1480 to 1520 would be the target, and that's exactly probably where we're going to end up. A lot of chart resistance at this level. And so the first quarter of next year will be about bursting through 1520 to 1550. Once above there, I think the next target is 1650. And the reason that'll happen, again, is the U.S. economy continues to slow, just like it did in 2010. And the Fed, having no other choice, is going to continue to monetize, just like it did in 2010. That supports soaring bonds, that supports soaring gold. And eventually that trickles over as well to the mining shares. And so, yeah, it's been a great year. But in my opinion, I think we're just getting started. And so it's not, the old adage about the train leaving the station, I don't know. I guess the bell's, clanging and we're starting to chug and there's a whole bunch of steam out there. But there's certainly time for people to position themselves for a whole lot more gains next year.
That's just so you're comparing 2019 to 2010. That's very interesting because 2011 was obviously the record year for mining shares for gold, silver, etc.
Yeah.
And
what happened, Lior? Excuse me. What happened in 2010? And we had all these talk about green shoots. And the economy was coming back from the Great Depression, recession, and QE1 was supposed to just be a one-off. That was announced in March of 2009, and that was never going to happen again and all this jazz. And the U.S. economy was growing 3% in the second quarter of 2010, but then it began to slow, actually went negative in the fourth quarter of 2010, negative again in the first quarter of 2011. It was in November of 2010 that QE2 began. And once that started, that's when silver went from 18 to 48 in 8 months. And then gold eventually went from $1,100 to $1,400 to $1,900. Here we are again. Again, we were at 2% some odd GDP. They're trying to tell us that the Third quarter was 2%. That's just because they're understating inflation. But a lot of fourth quarter estimates, and here we are in December, are well under 1%. All the signs, the data that we're seeing, even the moves in the yield curve are indicative of the early stage of a recession. So I expect more weakness to carry over into next year. And again, that looks like 2011. So this pattern continues. It may not be the steroidal, if you will, impact that we had in 10, 11, but definitely a continuation of the uptrend. And that's something that people, again, can position themselves for as we move into next year.
Definitely. And like I said, they said after QE1, they said enough is enough. We're not going to do any more. And then QE2 came. It kind of reminds me of what they're saying right now. This is not QE. What we're doing, This is not QE. What the market is reading is that if this is not QE, then there's still room for some QE, and that might trigger what you're talking about, reflation effect. I want to ask about something that I see a lot in the political debates, and that's the inequality issue. We see also that it's become the turf war of billionaires. Should the government come in and redistribute wealth, while other people are saying, hey, I don't know what happened to America, where people fail and get up and fail and get up until they make it. But on the flip side, you see people that say, hey, people that fail and get up, when they start to get up, there's nothing to get up to. The career paths are gone. The U.S. is not ready for the 21st century. They're still living off of this idea that the baby boom miracle will come back, manufacturing jobs will come back. And I want to ask you about this problem, philosophically and more structurally. Is it do you think the problem starts with the government, starts with the central bank, with both? Do you think it's just a fact of it's just a byproduct of the fact that people don't read in the U.S., that people, 97% of people don't pick up a book in a year? Where is the source of this, the core of this, and what do you think will be the answer that either the authorities or the free market come up with in order to solve? There's always inequality, but what many studies are showing is that this is the largest inequality since the 1930s, and that's the problem. Not that there's inequality; there's always going to be inequality. The size of it, and the fact that people don't believe that they can start a career today and climb the corporate ladder that easily, or the business ladder for that matter. You were in the heart of the United States. Talk about a little bit in your local area and just in general, what do you think is next for this?
Well, Leo, this is a subject that's near and dear to my heart. My site, TF Metals Report, has always had the subtitle, if you will, about we call it the end of the great Keynesian experiment, with John Maynard Keynes being the kind of the father of this monetary theory that we've followed now since the 30s, where you just print as much money as you need and create more and more debt, and then create more and more money to create more and more debt. The shortest answer to your question, I'm quite confident of that answer. I call it the political financial complex that has put us in this spot. And that is just this ever expansion of the government and the government services and the government spending, creating more and more debt, that the currency that's supplied by the Federal Reserve System that helps their banks because they create more and more cash, and the banks can charge interest on it. And there's this whole bastardized system that has driven this inequality. That is the root cause of the income inequality, the wealth inequality. And ever since QE, then and the trillions and trillions of dollars of currency that's been created ever since, it's been exacerbated and made worse. The first thing that comes to mind is just last evening here in the U.S., I was watching the U.S. news program 60 Minutes. And on there, they had a whole segment about the tent cities and the homelessness problem that it's just getting. Now, we've had, again, homeless forever, right? But it's getting worse and reaching new extremes, particularly on cities in the West Coast. They focused upon Seattle because they were saying, well, look at Seattle. You got all the, you got Apple and you got Microsoft, and you got all the techs out there and Boeing and all this kind of stuff. And they, Seattle should be all kinds of jobs for people. But there has been so much cash created that has flowed into only the wealthiest hands, that in Seattle, the amount of that is now for real estate and for rents has priced all of the regular people out of the market. So like in San Francisco, what is it, like $3,000 a month for a 1,000-foot studio apartment? Well, the income, you don't have enough income to be able to pay for that, to have your rent soak up that much of your monthly inflow. And so this problem just continues to worsen. And again, you can lay that at the feet of the central bankers and the politicians who have no desire to solve problems. So they just simply pit one group against the other to say, well, no, it's this group's problem. It's their fault for this income disparity. So we've got to raise taxes. And the other group of politicians says, no, it's the other group's problem. We've got to cut taxes. And all they do is they pit one group against each other. So they always create these voting blocks to maintain their own power. They're not interested in solving anything. And again, the whole system is this ugly, greedy system where the politicians and the financial complex kind of feed off each other. Then you go all the way back to when it got exacerbated and began was in 1971 when Nixon closed the gold window, as they said, and removed the convertibility of the dollar into gold. That's when anybody can chart this. That's when the income and wealth disparities really began. I'm 53 years old. I remember my father used to, what do you make? $30,000, $40,000 a year with a good job in the 70s. My mother threw on $5,000 a year teaching school, but yet they put my brother, my two sisters, and I through college. They paid their mortgage. They had a country club membership, all this kind of stuff that nobody can afford today. So incomes have maybe risen a little bit, but the cost of living and the taxes and everything else to feed the beast created by the politicians and the bankers just keeps increasing. You asked what the solution is? Well, the solution is you got to completely eliminate this current system and get back to some method of sound money and responsibility. I don't know how we're ever going to get there, though, Lior. Too many people have grown dependent upon this system. And I just don't think there's a political will. There's not a personal will to go through the adjustment. Now, maybe the adjustment, the move to the new system will just be forced upon us and we won't have any choice. But to ever get back to that kind of American dream you mentioned, we're going to have to get back to the original American monetary system. And man, that's going to be a hard transition because you mentioned education, not many people understanding, why you'd want to go back to that. The amount of dependence of people, on the government teat, if you will, to just kind of somehow keep going along, the dependence of the politicians and the bankers and the media that is their sycophant, promoters. Man, it's going to be it's a tough hill to climb. So anyway, long answer to your question, but that's a whole Pandora's box that, man, we could probably sit here and talk about all day.
You talked about the fact that gold and silver had the best year since 2010. The markets have had a remarkable year as well. In fact, since Trump's election, the S&P 500 is up more than 50%. It's just up since the December lows. It's up 35%. Markets are trading at all-time highs. I think they broke just this year about 25 record days where you've had new all-time highs. But investors have been pulling money out of stocks forever. Like all through this bull market, the biggest buyers are CEOs, approving repurchase programs, buyback programs. Many people have tried to call the top, and here we are at new all-time highs as we're doing this interview. Where do we go from here for the broad indices? Because the amount of wealth that is being created is in the trillions for shareholders of these corporations, for pensioners, etc. Could you talk a little bit about what do you think about the general indices in 2020, especially with the elections coming up?
Yeah, Leo, I gave up trying to call a top years ago. All the stuff that I used to follow, I've been at this since 1990. I passed my Series 7 and became a stockbroker in 1990. And so I go back a few decades now. And this is not a stock market anymore. It used to be, that these companies, they had earnings, and you would try to project what their earnings were going to be, and the stock might trade, off of fundamentals like price to earnings, and earnings per share and stuff like that. And you'd think, okay, well, earnings are going to go up 10% this year, so maybe we can look forward that the stock will go up 12, and mom and pop would buy 200 shares of that company because they think it's a good investment. And that's all. None of that happens anymore. None. I mean, the entire stock market now, 85% of it is high frequency trading computers, just swapping positions back and forth. And you mentioned this ongoing rally since October, or actually it dates back to September. What happened in October? What happened on October 11th? That's when the Fed announced, this new QE program. That's not QE. They're just simply monetizing the debt. They're not giving away free money to the banks. And so I guess that's what makes it not QE. As soon as the Fed began pumping liquidity, all of a sudden the stock market goes up. And that's consistent. I mean, anybody can go back over the last 10 years, pull up a chart of central bank balance sheet reserves, the amount of cash that each of the central banks created, run a global chart of that, and then plot the S&P with it. And they move up almost tick for tick together over the last 10 years. So long answer, short answer, whatever, as long as liquidity continues to increase, meaning as long as the monetary base, as long as the banks continue to float more cash and create more cash, the central banks, the primary dealer banks, the big money center banks, the investment houses, they're going to continue to put that money in the stock market. The HFTs are going to continue to trade it. The other, look at the Swiss National Bank. I mean, they own $100 billion worth of what? How many different equities in the U.S.? I mean, it's as long as liquidity keeps growing, stock market will go up, regardless of what the fundamentals are. And so like I said, I stopped trying to call a top a long time ago. Now, on the flip side of that, what if liquidity doesn't continue to go up? You get an event like last December, where the stock market was collapsing. That is something that needs to be watched, because if folks will recall, back in the middle of September, the interbank liquidity, what you'll hear termed as the repo or repurchase market, where one bank borrows cash, typically on an overnight basis, from another bank. They need cash for whatever, I need $10 billion just for the night, as we settle up everything that happened today, but I don't have the $10 billion. So here, Mr. Bank A, take $10 billion of my treasuries and then give me the $10 billion in cash back. And then tomorrow, once I have the cash again, I'll give you your 10 billion plus a little interest, and you give me my treasuries back. That's how it's supposed to work. The banks trust each other. Well, since the middle of September, for whatever reason, there's been a crisis of confidence. That interest rate that they charge each other shot higher. We had the beginnings of a liquidity crisis, and that has not changed. People tried to write that off as an end of quarter issue back at the end of the third quarter, and we made it into October. Then all of a sudden, the Fed announces these repo facilities that were going to be $75 billion a day. Now they're up to $120 billion a day. The use continues to grow. As we head into the end of the year, it's only going to get worse. It's as if there is a major liquidity problem or a lack of trust amongst banks. If that gets away from the Fed, which I'm not sure how it would, but if it did, that could kind of spiral out of control. And again, you start losing liquidity and cash, then all of a sudden you get margin calls, and then you get even less trust amongst the banks. And then we're back into kind of a 2008 situation. So that specter is always looming, right? And I mean, people be foolish not to be paying attention to it. But in the meantime, as long as the central banks are pedal to the metal, pumping out new cash, that cash goes somewhere and goes into global equities, it seems.
Yeah, a lot of the dollar shortage came from European banks that were really strapped for US dollars. That has a lot to do with the repo markets. And I want to ask you about, obviously, the most important trade issue in the world, and some say the mover of all the indices in 2019, the China-U.S. relations, especially when it comes to this escalating the tariffs back, taking them back, taking it forward, part of the phase one deal, etc. Is this something that will be with us for many, many years? In other words, are you seeing some sort of a Cold War scenario between the U.S. and China? Or do you see this as a handshake, inked agreement, and the start of a 21st century deal between what would be the two powerful economies of at least the next few decades?
It's going to continue at least as long as Trump is president, I'd say. And remember, he's up for re-election in 11 months. So I expect this nonsense to continue. And it is nonsense because it's now been going on for what? Over a year? Every time it looks like the stock market's headed down, they run out Kudlow to talk to Kramer, or some other goon from the administration to say, China really wants a deal. And then with these markets being driven by HFT computers, one of the things they do is scan the headlines, and these computers see China deal in the same headline, and they start buying S&P futures, and magically the market goes up. I mean, seriously. I mean, that's how it works. So what incentive do they have to really solve it at this point? If you want to, here's Trump every day tweeting about how great the stock market is. As long as you've got that card in your back pocket and you can drop it on the table repeatedly every other day, keep the stock market afloat that way. And even when they talk about this, Leroy, it's always about phase one. Well, phase one is allegedly the easiest part of the negotiations. And they can't even get that done, for God's sake. I wish they would, because I'm so sick of this. But they can't even get that done. And so as the calendar flips into 2020, why wouldn't the Chinese begin to look around and go, well, geez, I mean, we can just outlast this cat. We've put up with this for a year. Why can't we put up with it another 10 or 11 months? We get a Democrat elected instead. They'll probably want to work with us in a different way, and we'll put all this behind us. So, as we go into 2020, the Chinese will probably be a little more recalcitrant, less willing to negotiate. And that may impact things too. That may, obviously, when that is going on and the yuan is weakening and all that kind of stuff, that's been good for gold this year. So that may be another factor that helps us out next year. But I don't think this trade war is going to get solved in the next couple of months. I think it's more likely that, like I said, the Chinese will just start to look at the calendar and go, well, we'll just dribble here in the corner and run out the clock.
Yeah, interesting. It's been going on for almost a year and a half, so it's going to be 2 years once he's elected. And I want to ask you about what would have happened if you had to put on the hat of Jerome Powell. What would you be considering right now? What would you do right now? I'm not talking about changing the entire system, not ideology, etc. You are put into this difficult position of being the Federal Reserve Chairman today. What would be the rates policy that you follow, and why would you select that one?
I actually, this sounds kind of funny. I mean, I never liked Bernanke. I never liked Greenspan. I thought Bernanke was a con man and a liar. And, the amount of stuff that he spewed to Congress that's now been proven to be lies shows he's a bad dude. And Mother Yellen, was just this purple-clad little grandmother that tried to reassure everybody that things were fine. I kind of like Powell. I mean, I think on the surface, I've never met the guy, obviously. Seems like a nice, straightforward guy. But he's an actor at this point. I mean, his job is to play a role. And that his role is to put out this story every time he's in public that everything's great. That the Fed is this group of economic, wizards that have things completely under control, and they know exactly what they're doing to keep the confidence game going. Because again, that's what this is all about, especially in pumping the liquidity. Oh, everything's fine. We know exactly what we're doing. When in fact, they've been making it up as they've gone along now for 11 years. And now here we are in 2019. They cannot, not they, I shouldn't say they, the system that they feed cannot afford higher long-term interest rates. Can't. And we've known this, you and I and everybody else in our space has known this now for years. Because higher interest rates do two things, and this is what forced their hand earlier this year. On the consumer side, The private sector, you got, much higher interest service costs, credit card rates go through the roof, mortgage rates go through the roof, all that kind of stuff. The economy then begins to crash and contract. When the economy crashes and contracts, tax receipts at the local, state, and federal level begin to crash and contract as well. So then you look at the public side, and you got all this massive amounts of debt, both at the state level here in the US, but obviously the federal level, everybody knows about it. Well, the only thing that keeps that to only $1 trillion deficit every year is the tax receipts, right? Now you spend $4.5 trillion to take in $3.5 trillion, you got a deficit that they state of $1 trillion. But then the other part is the interest on the existing debt. They've been able to shove into such short maturities and lower interest rates so far that even as the debt accumulates, the interest on the existing debt that they pay every year has kind of gone sideways at around 400 to 450 billion a year. Okay, well, hell's bells. What if tax receipts fall by $500 billion because of a recession, and then interest rates double, and all of a sudden the interest you pay on the national debt goes from 400 billion to 800 billion. Well, now all of a sudden you got a $2 trillion national debt. And the whole thing just spirals out of control, which is why, in the end, the Fed has to facilitate this system through everything that they can do. And all the central banks have to. They got to keep pumping liquidity. They got to keep going with the QE. They got to do everything they can to keep it going. So putting it all back together, I don't envy Powell, right? And he's just an actor. He's the one that's got to make it sound like he's got it completely under control. They know exactly what they're doing. When in the end, all they're doing is they've got plates on all these different sticks, and they're trying to just keep them all going and keep everybody as confident as possible so that the thing perpetuates a little bit longer. It's worked, especially was working really well in about 17 and in the first part of 2018. But now the thing is, it's just starting to kind of implode on itself. And he's got a tough job ahead of him. I don't envy him one bit.
Craig, where can people check out more of your products and what you do at TF Metals Reports, and tell people exactly what's going on with you guys?
Well, thank you, Lior. We focus on gold and silver, right? And that's the main mission of the site, is to encourage people to continue to take a little bit of money and buy physical gold and silver, because when the system resets, like we talked about, we may not do it voluntarily, but it'll be forced upon the world at some point. When it resets, invariably, what happens? You go back to that anchor. And so your protection against that madness is physical metal, not the GLD and that kind of stuff, physical metal. So that's what the site's about. And I provide some analysis about where prices are headed so people can kind of time their purchases and things like that. But it's a much bigger picture. I don't think there's a lot of websites that look at the world the way we do, as realistically and as rationally as we do, having discussions like what you and I have had here for the last 20 minutes on a daily basis. And so you get all of that for the whopping total of $12 a month, which 30, 40 cents a day. It helps me keep the lights on. I got a business to run here, but we don't want to price people out either. So please come to TF Metals Report, especially at what is ahead in 2020. I think that $12 a month might be the best money you could spend at this point. Again, tfmetalsreport.com.
Hey, Craig, thank you very much. And let's definitely circle back at the beginning of next year.
Let's do it, Lior. My pleasure. All the best to you, my friend.